Hello friends, wish you a very happy and a prosperous new year. Last week I took a break from my videos, but I updated my social media accounts, especially my Telegram channel, with my weekly live mint article, which covered the basic statistical and the market outlook and levels, etc. for both the indices. I hope my viewers did not miss the action too much because the video was missing, because my Telegram channel provided all the updates. And good news for my free Telegram channel subscribers. Come Monday evening, end of the day, we are going to start updating monthly pivots for equities and commodities, so that my online family, which is basically writing options in any or both equity and commodity segments, also can benefit additionally by choosing the right strike prices and making more profits from the market. So all the best, and do subscribe to my Telegram channel. Now in this video, I want to discuss whether the bulls are back. Are they actually going to come back and grab the initiative from the bears, or are the bulls a little more circumspect? Let's dive right in, and on your screen is the market roundup window, which tells me that it was a broader based Nifty 50 which led the charge upwards. Not surprising, because the oil prices rose and therefore inflationary concerns came back. The US dollar index, the DXY, fell by 121 basis points, and that basically cheered emerging markets, including India, which is why a major reason why the rally occurred. Gold and silver witnessed surprising downticks in spite of a weak dollar, because risk on sentiments, which is risk appetite for paper assets, returned. India's 10-year benchmark bond yield fell by 12 basis points, which means bond prices rose. That cushioned the bank Nifty from declines. Market cap rose a little under 1%, and beautiful tailwinds were seen from the US markets, which triggered a good kind of a upthrust in the Indian markets. Talking of the US markets, is a daily chart of the US Dow Jones Industrial Average on your screen right now. Price has broken upwards of the 200-day moving average, although the death cross where the 50-day moving average is below the 200-day moving average still remains in place, and we are heading towards the first critical threshold of 33,272. If the Dow starts trading above that, then it would have cleared a significant hurdle on the upside. The daily chart of the Nasdaq 100, the index that is directly responsible for the outlook on the domestic technology stocks, is relatively speaking a lot more muted. The price has not even crossed the 50-day moving average, forget about the 200-day average. And the death cross remains in place. The major level to watch out for will be the 12,898 levels, far off from here where we are currently. So the Nasdaq is relatively underperforming the Dow Jones. The S&P 500, which is the broadest based index of the three, is also witnessing a death cross. The price has still not closed above the 200-day average, unlike the Dow. And here again, which means it is the Dow which predominantly has led the way forward. The US markets are not completely out of the woods yet, but the outlook definitely has improved a little. That's a positive sign. Now for the MWPL, which is a good risk gauge of the two Marshmallow traders. The Marshmallow theory video is in the description and the pinned comment below. Are basically showing lower risk appetite, because the post-expiry first Friday of the month after expiry has seen MWPL at 21.28, which is lower than 21.65 in the week prior. And in the prior expiry, I mean. That tells me that risk appetite has contracted. Ever so mildly, but it has contracted. Do remember that the peak at 29 is significantly lower than the previous peak of the previous monthly expiry at 33.59. Part of the reason, it could be the festive season when a lot of Indians buy a whole lot of new assets, basically car, house, household gadgets, etc. in the auspicious period of Diwali, and therefore allocation to equity markets tends to be lower. But even adjusted for that, the peak at 29 is sharply lower. That tells me that it's the one Marshmallow traders which are basically responsible for having pushed the markets higher. Two Marshmallow guys are still circumspect. Now for the stock and index futures turnover, which has seen a sharp decline last week, not unexpected here, because Monday was a token Muhurat session, which is a 1 hour kind of a token session, which basically tells you that it was a truncated week and therefore volumes were expected to fall. Now for the advanced decline ratio, friends, one of the reasons why I did not record a video last week was we wanted to upgrade our statistical trading model. If you notice something, this as the line below the title tells you is a weekly average of the advanced decline ratio. Earlier, what I was just giving you was the Friday's advanced decline ratio. So we were comparing Friday on Friday. Now, what we have taken is the average of all trading sessions in a week and compared it to the previous week, which is again an average. So week on week, the advanced decline ratio has risen for the second consecutive week here. Now that tells me that there's been some accumulation happening on declines, which is the first green flag that I'm getting here in our markets. Now for the basis is nothing but the discount of premium enjoyed by the futures over spot. The basis has jumped. It's not something to be surprised about. This is expiry. And the post-expiry basis does tend to expand because traders have 4 full weeks to play around with and therefore are willing to pay a higher premium to buy or to go long. This basis is unlikely to sustain because as the derivative series progresses, the risk premium tends to start falling. So let's basically see whether basis goes into inversion again. Inversion is discount to cash, which Nifty did see. As long as inversion does not happen, bulls have a good chance. Now, for the Nifty and Bank Nifty impetus, this is our in-house exclusive indicator you've learned to trust and depend upon so much. The impetus for both the indices fell. Now, part of the reason could be that you actually had a truncated week to deal with and you barely had 3 full trading sessions to basically take positions and sink into the positions post expiry. Now, the impetus has fallen, which tells me that the force that should have been there in the buyer's camp was missing. This is a very mild red flag because let's not forget this was a Diwali week. Many people travel and take off from the markets. So I'm willing to give bulls a benefit of the doubt because the impetus is down. Now for the LWTD, here again, the LWTD has witnessed an upgrade. Now the Nifty percentage gain loss line has fallen to 1.20. In the prior week, it was higher. But the LWTD line, although remaining below 0 for the 8th consecutive week, has risen a tad, which means that the bulls may offer muted and weak buying support, but that buying support is likely to be improved as compared to the past fortnight. So, barring any unforeseen circumstances, don't expect a sudden or a sharp kind of a outlier kind of a fall in the Nifty. Now for the footprint of the four market participant types, I start with the FIIs who increased their net long positions in stock futures, almost doubling it, and went net long in index futures by 17,394 lots where they were earlier, net short by 76,850. So FIIs have turned positive. DIIs have increased their short positions in both the indices and stock futures because they tend to support the market in the spot segment and they hedge their purchases by going short in futures. The prop segment has gone net short in index futures where last week they were net long, and where their individual stock positions are concerned, they've increased their net long positions by approximately 20,000 lots. Now, these are savvy brokers' own trades, so they tend to know who's buying and selling and how much. So if they've increased their net long positions, part of the reason, of course, is that after expiry, people tend to increase their exposure. In the run-up to expiry, they reduce their exposure. So part of the reason could be a post-expiry ramp-up of fresh positions. Now let's go to the retail guys who've been doing all the heavy lifting after the COVID lockdowns came in. Their net long positions in stock futures have gone up by approximately 19,000 lots. Here again, post-expiry could be one of the reasons, but their net long positions in index futures have fallen off a cliff, less than 50% now on a week-on-week basis. That is huge, huge decline in index net long position. So the retail traders tend to be sitting on the fence here, relatively speaking. Let's now see what the four index heavyweights have done in the week and how they are likely to support or drag the indexes. Reliance Industries, the biggest boy of them all, 10.84% weightage in the Nifty with high beta of 1.11, has basically risen on 3 out of 4 trading sessions and has closed comfortably above its 25-day exponential moving average, which is a month-long holding on cost of an average bull. The average itself is rising and is headed towards the first immediate hurdle of 2,542. Should it start trading comfortably above this level, your next hurdle will be 2,618. By the sheer weightage of Reliance Industries alone in the index, what we have seen is the Nifty getting good support, especially what you saw on Friday. The Nifty went up due to the sheer rally in Reliance alone. Now, HDFC Bank, weightage of 8.27% on the Nifty and 26% in the Bank Nifty. Quite simply, the heaviest weighted stock in the Bank Nifty. So what happens to this stock impacts not just the Nifty, but the Bank Nifty as well. Now, this stock also has risen on 3 out of 4 trading sessions. Price stays above the 25-day exponential moving average, and as long as it stays above the 1,421 levels, the bulls are still in charge. And what we would ideally want is a sustained trade above the 1,480 levels for a fresh upthrust to start. But net-net, both Reliance and HDFC Bank are expected to cushion any declines in the Nifty and Bank Nifty. Infosys, purely a Nifty composite stock, weightage of 6.84%, fell on 2 out of 4 trading sessions. The falls were bigger, but the only thing that kept Infosys out of the woods was the gap up open on Monday. The 25-day exponential moving average is rising upwards. The price is above it. So the outlook has improved somewhat. But we still need to trade above 1,555 for Infi to support the Nifty any significantly and forcefully. ICICI Bank has fallen on 3 out of 4 trading sessions and the falls have been steep. Very, very steep. It's closed the gap which it had opened on Monday for the Muhurat session. And what is important about this stock is the weightage of 7.94% in the Nifty and 24.97 in the Bank Nifty. So this is the second heaviest weighted stock in the Bank Nifty and fourth weighted stock in the Nifty. This stock must stay above the 867 levels all of coming next week, or the bulls are in trouble. The price remains above the 25-day exponential moving average, which itself is turned higher, which means the outlook still remains optimistic for now. Now, friends, I come to the bond markets, which basically saw the Indian bond yields come down, which means bond prices went up. We are heading towards a very critical period where the US Federal Reserve is meeting on 2nd of November to consider interest rates. And 3rd of November, there's been a very surprise off the agenda RBI Monetary Policy Committee meeting, which has suddenly been announced. And my guess is that they will react to whatever happens in the US's previous nightly meeting. So bond markets are likely to remain a little jittery, but what we have seen is the bond yields have come down, which means bond prices have risen. That provided a cushion to the Bank Nifty. Had it not been for the bond market coming down, I think Bank Nifty would have ended in the net negative. I've been posting a lot of stuff on my Telegram channel about the banking space, and I'll keep updating on any segment of the market which deserves attention from us as traders. So please do connect with me on my Telegram channel and subscribe to that free channel. All the content is free. I don't charge money for this channel. So what I do need to watch out for is the 7.27% yield threshold. Unless and until the Indian 10-year benchmark bond yield starts to trade consistently below 7.27%, I would still say that bond yields are headed higher. Any close sustainably above the 7.55% will basically see the bulls getting aggressive again on the interest rate outlook, because rates are firming up, and if bond yields were to start rising, that means the RBI meeting is likely to have a higher probability of a rate hike. Now, friends, I come to the US dollar index, which is a very critical aspect for emerging markets, including India, because we are net importers, and the dollar price determines the landed price of imported goods here. To that extent, a very strong dollar results in imported inflation, and this needs to be monitored. Now, the US dollar index, as you can see on the daily chart on your screen, has surrendered 121 bips and has closed below the 25-day exponential moving average, which is a month-long holding on cost of an average bull. The average itself has started to turn lower. What we need to see is whether the 109 swing high, the erstwhile swing high, is being respected by the market as a support. As long as it holds, the bulls have a fair chance of coming back. But it will require the US dollar index to trade consistently above the 112.95 levels to be able to get into the bullish groove again. Now let's take a look at the weekly chart, where the price has fallen for the second consecutive week, although the closing is way higher than the intra-week low, which is the 109 support. Now, the price is significantly higher than its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook also remains positive. Last week, there was no video, so no range was advocated. But in the coming week, I expect an estimated range between 112.95 on the upside and 108.40 on the downside. Do keep watching this index, because the outlook on Indian bonds and even commodity prices will depend on the level of the US dollar index. Friends, I now come to the Bank Nifty, which barely managed to hold on to its gains on a week-on-week basis, gaining 0.51%. As you can see on the daily chart on your screen, this index rose on 2 out of 4 trading sessions. It was the gap up on Monday which saved the bulls from the blushes. Had it not been for this gap, the Bank Nifty would have actually reported week-on-week losses. As you can see, the price rose on just 2 out of 4 trading sessions. The falls were actually more prominent. The red candles are bigger than the green candles, but like I said, it was a gap that saved the day. The price is above the 25-day moving average, which is a month-long holding on cost of a bull. So the outlook for the absolute near term remains positive. 41,840 is the previous swing high, which will act as a near-term resistance for now. Once you overcome this threshold, the probability of bear covering come fresh buying, pushing prices higher cannot be ruled out. But do read my banking update on my Telegram channel if you're a Bank Nifty trader. Now, taking a look at the weekly chart, what you are seeing is a bullish candle, but the closing is lower than the open. So towards the fag end of the week, there was profit taking at higher levels. The price remains above its 25-week exponential moving average, which is a 6-month holding on cost of an average bull. So the medium-term outlook is positive, but the 41,840 level remains a hurdle to overcome, without which the bulls might struggle a bit. In the week before last, this index was at number 3 on our most volatile list in-house. It fell by 1 notch to number 4. Not just because the index actually was less volatile, but because individual stocks volatility went up substantially. Although last week there was no video, I advocated the ranges in my live mint column, which I shared with my online family. And the range I advocated was 42,400 on the upside and 39,175 on the downside, which held perfectly well in spite of all those gaps. In the coming week, I estimate a range between 42,550 on the upside and 39,450 on the downside. Here again, please continue to trade light, maintain stop losses. Friends, I now come to the Nifty 50, which led the rally by rising more than the Bank Nifty last week, and it rallied on 3 out of 4 trading sessions, as you can see on your screen. The price has broken out above the thick red bearish trend line, which connects all the peaks made by the Nifty from October 2021. So there's been a breakout of some sorts. And the price is above the 25-day exponential moving average, which is a month-long holding on cost of an average bull. And the average itself is turning upwards, which means the near-term outlook remains positive for now. What is holding the Nifty back is a breakout above the 18,115 threshold, which is a double top, which I have marked with a blue trend line on the daily chart, as you can see. You clear this hurdle and bear covering come fresh buying will push this index significantly higher. Now for the weekly chart, my friends, as you can see, the price is above its 25-week exponential moving average. So the medium-term outlook remains positive for now. The candle, the last candle, is significantly smaller than the previous week's candle, which means the range was smaller. No surprises there. It was a short, truncated week. Diwali holidays, people travel, and participation was low. But the 25-week exponential moving average remains a support area to watch out for. That is 17,150. And here again, you'll need to break out above the 18,115 levels to trigger short covering come fresh buying. Friends, in the week before last, this index was at number 8 on our in-house statistical beta list of the most volatile counters, but it slipped 2 notches to number 10. Here again, it was individual stock futures volatility that had risen higher. Last week in my media column, I wrote about the range estimated between 18,125 on the upside and 17,025 on the downside, which held perfectly well. In the coming week, I expect an estimated range between 18,325 on the upside and 17,250 on the downside. Here again, please do trade with abundant caution, keeping stop losses in place. Friends, one last chart of the retail risk appetite last week, which is shown by the options and futures turnover in individual stocks compared to the turnover in indices. What we basically want to see is whether futures turnover is rising, because futures are traded by higher risk appetite, deeper pocketed traders, and therefore are a good benchmark. The daily chart of the component of turnover contributed by various segments tells me that both the stock futures and stock options turnover was lower as a percentage of the total turnover compared to index futures and index options, because risk appetite was lower. Like I've been telling you throughout this video, part of the reason I'm willing to attribute is the holiday season. People travel and therefore risk appetite tends to be down. Friends, all the charts done. I now come to the most popular segment of this video for statistical model traders, wherein I give you 5 stocks which lost the highest amount of statistical beta and impetus on Friday. So you take a big exposure, wait for small price moves, and 5 stocks that gained the most amount of impetus on Friday. So you take small exposure, wait for large price moves. Why the difference? Because different types of traders, different types of techniques, so different tools of the trade. The statistical beta and impetus gainers list is led by MCX at number 1, NMDC at number 2, Maruti at number 3, Hero Honda, Hero Motocorp at number 4, and GMR Infra at number 5. The impetus losers for Friday, where you take bigger exposure, wait for smaller price moves, is led by Wipro, followed by GNFC, number 3 India Cements, number 4 Escorts, and number 5 Federal Bank. Friends, this hierarchy changes day to day, and if you want to be updated with this list, please do subscribe to my free Telegram channel, where this list is posted Tuesday through Friday. And before I wind up this video, a humble reminder to click like on this video if you liked what you saw. Subscribe to my YouTube channel if you haven't already done so. And in the comment section, do let me know how my videos are helping you trade better. A reminder again, Monday evening onwards, we are putting up monthly pivots for both the Nifty and the Bank Nifty, so my online family can use this to write the correct strike price options and make more informed option writing decisions. I wish you have a very, very profitable week ahead. Till we meet in my next video, this is Vijay Bamwani signing off for now. Thank you for your patience. Take care. Bye-bye.